Alright, so hello everyone. I'm making this video from Tokyo on vacation with my family, and I did post on that yesterday. I'd like to really thank a lot of you for your very kind comments and best wishes. But I couldn't help but make this video because Buffett's annual letter came out, and it's something that I read enthusiastically every single year, and the man is really 92 years old. Sadly, we won't have a lot of letters left, so it's something that I really want to talk about. Also, at the same time, my wife and two kids, they've gone shopping, and I hate shopping, so I'm pretty bored in my room, so I thought I'll just do this quick video. Out of the many people who have influenced me over the years, I would say that Warren Buffett has had the greatest impact, the greatest influence on my investing career. And I would say that I would not have made the money I've made in my life, not just in investing, but in my businesses, without the wisdom of Warren Buffett. And what's very important to note is that while I followed his investment philosophy, while I've followed his life philosophy, it does not mean that I have followed the stocks that he has bought. In fact, there are many stocks that he has bought over the years that, I would never buy because it didn't fit my investment criteria. So that's something to learn as well. You can admire someone who's really successful, follow their philosophy, but it doesn't mean that you buy the same stocks that they buy, because you have to follow your own investment plan. So for example, many of you know that Buffett has recently invested a lot in energy companies, but I don't touch energy companies. Buffett invested in General Motors, he invested in IBM, which I read about, but those are companies that I won't invest in because it doesn't fit my investment philosophy. In 2019, he bought many of the major airlines, and I said, it's not for me, so I didn't buy the airlines, which was a good thing because he sold it a few months later for a loss, right? So one important thing to understand is that even the greatest investors in the world, even the most successful people in the world, they make mistakes, but they admit it, and there are times when they break their own rules as well. I remember I watched a lecture that Buffett gave back in the 1980s, and at that time he said that airlines were a terrible business. They've got terrible economics, and he said you should never buy an airline. He said every time I bought an airline, I lost money, and that's what he said. But in 2019, he broke his own rules and he bought airlines. So when I looked at it, I said, hey, he's breaking his own rules, right? And sure enough, when he broke his own rule, he lost money the next time. So what's important to understand again is that no matter how successful someone is, there will be times when they break their own rules and they make mistakes, but they admit it, right? And what's interesting is that by following his rules and following his philosophies, but not following some of the mistakes he's made, I've actually avoided a few bullets. So that's one important thing to understand. So out of all the great investors out there in the world, why have I chosen to follow Buffett's philosophy the closest? Well, it's very simple. It's because he has got the longest, most consistent track record in the world. Now think about it. There are many investors out there who have been able to make a lot of money, few 100% return, hundreds of millions of dollars in the short term, in 1 year, in 3 years, in 5 years, or even 10 years, but eventually they lost everything. For example, many people admire Jesse Livermore, one of the greatest traders in the world, which I did in the past. I've studied many of his books. Jesse Livermore made like over $100 million as a trader, but at the end of the day, he lost everything and shot himself, right? He committed suicide. Someone like Richard Dennis, also another great trader, who was the person who started the turtle trading technique. He made over $350 million net worth, but later on lost a lot of it as well. And then you've got people like George Soros, known as one of the greatest traders in the world today. And no, he didn't lose any money, right? But if you look at Soros, for example, the greatest traders in the world, and over the last, 30, 40 years, what's his net worth? It's about less than $7 billion. Yeah, sure, that's a lot of money, right? But compared to Buffett, it's nothing. Buffett's net worth today is $106 billion. So his net worth versus the next guy is more than 10 times. Now, granted, of course, he's a lot older, there's more time to compound, but it's also about consistency. Another guy that, I admire a lot as well is Stanley Druckenmiller, who was Soros's partner. And again, Druckenmiller, one of the greatest investors in the world, in the last 20, 30, 40 years, built a net worth of, again, close to $7 billion. But again, nothing comes close to Buffett's $106 billion. So it's all about the consistency and the very long-term track record. And that's what we're interested in, because as investors, I'm sure you're not interested in making a lot of money, a few 100% return in the short term, only to lose everything in the next couple of years. Because we want to make sure that in the long run, 10, 20, 30 years from now, when we are in our golden years, when we want to be financially secure, financially free and retire, we have the money to do so. And that's again why I've chosen to follow his philosophy the closest over the years. Now let's take a closer look at his track record. So he invests through Berkshire Hathaway, where you can buy shares in his company. Okay, but over the years his returns have not been as great as in the past, for a very simple reason, because once you're managing huge amounts of money, it's difficult to keep growing at the same rate. So it's a matter of the size problem and not the skill level, if you will. Okay, so since 1965 to the end of 2022, that's like 57 years. Okay, in 57 years, his annualized return, his compounded annual growth return has been 19.8%. 57 years. I mean, that is crazy. Now, if you compare it to the S&P 500, just buying the overall index, that's like 9.9%. So he has kind of like doubled the S&P for 57 years. No one comes close to that. But what's interesting is if you take a look on a year-to-year basis, does it mean that he's able to make money every single year? Of course not. You can see that even the greatest investor in the world, there will be years where he's down, right? Down 19% over here, down 31%, down 12%, down 4%. Why? Because remember that you have no control over where the market goes in the short term. And it's impossible to predict where the market goes in the short term, because in the short term, the market is driven by news, emotions, manipulation, and there's no way you can predict it with 100% certainty. As an investor, the only thing you've got control over are the businesses that you invest in, only investing in great companies and buying them when they're undervalued. So if you do that, you will make a lot of money over time. You beat the markets over time. But in the short term, you could still be down in a year or 2 years because you have no control again over the short-term movements of the market. So that's why I keep telling people, why be upset? Why be stressed when the market goes down in the short term? You've got no control over it. You can't predict it for certain, right? And as long as you hold on to great companies, you will do very well over time, just like what Warren Buffett has done. And again, does it mean that you can beat the index every single year? No. Again, even as the greatest investor in the world, take a look. In the last, for example, 30 years, more than 1/3 of the time, he underperformed the market on any given year. Where, for example, the S&P 500 on the right, gained 23%, but for that year, he was up 6%. And over here, imagine when the market's up 21%, but you're down 19%. You may think, I'm an idiot, or people think you're an idiot. No, it's not that you're an idiot. It's because, no matter what strategy you use, it can't be up every year. It's just impossible, okay? No matter what strategy you use, it can't always beat the market every single year. That's just the way it is. Because again, in the short term, the market is not driven by fundamental logic or value. In the short term, the market can be driven entirely by manipulation and emotion. So again, over here, look at that. Market's up 28%, he's up 15%. Market's up 10%, he's up 4%. So like I said, if you underperform the market in a year or 2 years, don't sweat it. There's nothing wrong with your approach. May not be anything wrong. It's just the way the market is. But again, if you stick to your investment philosophy, you stick to your plan, you can be sure 100% that over the longer term, you will definitely make money and you'll beat the markets. Now, if Warren Buffett is the greatest investor in the world and no one else comes close, why is it very few people, even very few retail investors or very few professional investors actually follow his philosophy? They pay lip service. They say, oh, he's a great investor, but very few people actually follow what he does. Why? Because to follow his philosophy, you must be able to go opposite of everyone else. When everyone loves a certain stock, it's a hot stock, you stay away. When everyone loves the market, everyone says, buy, you get out. When everyone says sell, everyone is panicking, that's when you buy. And very few people can do that because most people are programmed to be creatures of conformity. But to invest like Warren Buffett, you have to think rationally and not think emotionally like most people do. And one of the classic examples was during the dot-com boom. So at the time, what was everyone buying? Dot-com stocks. Any stock with a dot-com went crazy because people are saying that, dot-com is going to change the world. But many of these companies were not making money. Many of these companies were overpriced. So when everyone was buying dot-com stocks, Warren Buffett said, no, I'm not buying any of these dot-com shit stocks. And in the short term, he looked like an idiot. He looked like a dinosaur. He was losing out because the dot-com stocks were going up. And companies that he owned that were making money like Coca-Cola, McDonald's were not going up because they were boring companies, right? So at the time, check it out. During the dot-com, the S&P 500 was driven up by hype, and the S&P was up 18% during that time, right? But Buffett was down 23% in 1999 versus the S&P 500. Now, how would you feel if you followed your investment rules? You bought great companies that were undervalued and you're down 23%. And those idiots out there, your idiot friend, your idiot neighbor who bought crap stocks that were losing money was up 18%. How would you feel? You feel terrible, right? And you probably think something's wrong with my strategy. I'm going to abandon my strategy and follow someone else. But not Buffett. Buffett stuck to his approach and he knew that, you know what? In the short term, I don't care if I'm down, but over time, I'm going to be proven right. So you got to have that conviction to follow your investment strategy and not be seduced by short-term price movements that don't make sense. And sure enough, what happened? When the market was up and he was down in 1999, he was ridiculed by the media, by people saying he was a dinosaur, he's lost his plot. And in fact, this magazine, Barron's, they put up this article that asked, what's wrong, Warren? Berkshire is down for the year, but after 30 years of unrivaled investment success, he may be losing his magic touch. And every few years, people say that he's losing his touch because he's underperforming the market. But sure enough, what happens eventually? He's proven right. And you can see what happened after that, right? In 2000, 2001, the dot-com bubble eventually burst, and all these dot-com stocks that were not making money, overvalued, collapsed 90%. And all the companies he owned, like McDonald's and Coca-Cola, American Express, were making money. They then started to gain. So when the bubble burst, the NASDAQ was down 72%, the S&P lost 28%, and Buffett gained 80% over the next 2 years. And you can see exactly what happened over here. All right. So again, during the dot-com bubble, you can see that the S&P went up, the one in blue, and he went down. He looked like a monkey, but he stuck to his philosophy. And over time, he would beat the S&P 500. And this repeats every few years. Same thing happened in 2020. What happened in 2020? ARK ETF, right, run by Cathy Wood, she looked like a genius. She bought a lot of these stocks that were not making money. All these hyped up tech stocks that went up like crazy. And Buffett, who again refused to buy companies that are losing money, he only buys companies that are making money. He looked like a guy who, again, is a dinosaur, lost the plot, right? And again, people laughed at him and they said, Cathy Wood's the next Warren Buffett, SBF is the next Warren Buffett. And sure enough, what happened, right? At the end of the day, fundamentals matter. At the end of the day, it is companies that make money that will be sustainable. And we know what happened after that. Eventually, ARK collapsed and Buffett again overtook ARK. So I love to use this analogy that, Warren Buffett is kind of like, it's like the tortoise and the hare. People think the tortoise is slow, he's boring. No one wants to be the tortoise, right? But the tortoise is slow and steady. It keeps making money consistently year after year over the longer term, right? But people are all excited about the hare because the hare goes, whoa, making a lot of money in the short term. But in the long run, that the tortoise always wins the race. The hare somehow will always shoot himself in the foot and collapse. So that's why most people find it hard to follow Buffett because it looks very boring. It looks very old. But you know what? If you're interested in really building wealth for the long run and to be financially free in the long run, then it's the only way to go. Now, every year, Warren Buffett writes an annual letter to his shareholders together with his annual report, which I highly recommend that you read. Now, this year, his letter was relatively short, but powerful nonetheless. He didn't really teach anything new because his philosophy has been very consistent over the last many years. So it was really him emphasizing many of these golden lessons that we need to follow as investors. So let me just highlight some of these lessons that he talked about and bring a bit more meaning into it. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.